Um, Hello, everyone. Welcome to the Equinox New Braunfels Phase 2 investment opportunity presentation. It's actually a refreshing change for us to present an existing advanced stage project with a 4% locked-in construction loan to our investors and give you a chance to jump into the project just 10 months from when the first 32 units are scheduled to be delivered. Today, you're going to learn about our favorite Texan market, the city of New Braunfels, and hear why Anna and I invested over $1 million for several years without any returns, because we believe that we've got a home run project in a fantastic location, and you'll find out why our belief in that home run has actually gotten stronger over the last 2 years that we've been working on this project. Our agenda is action-packed. After we introduce ourselves, we will first catch you up on the first 30 months, the phase 1 of this project, and then we'll share our insights on the metro, the market, and the sub-market, and then share our reasons for wanting to build at this amazing location. More than any other project that we've invested in, this project is all about location, location, location. Let's see. Ooh. And then we're going to give you several minutes. We're going to take several minutes to give you a very visual and fun walkthrough of the property's design, its features. You'll see the numbers for phase 2 in detail, everything from assumptions to loans to splits to returns, rents, and a lot more. We'll give you the timelines and the investment minimums, and then we will jump into a detailed Q&A session. Some quick housekeeping. Feel free to type in your questions into the Q&A box, Anna will be asking us these questions at the end, and you will get a copy of this webinar in your inbox in 48 hours, just in case you need to jump off. Please note that the numbers might change, though given that you're investing in phase 2, we think that they're pretty dialed in. Our lawyer wants you to know that this webinar is not a solicitation to purchase securities. For that, you would need to review the PPM and the subscription docs. Our goal today is to get you comfortable with the information so you can continue your due diligence with the investment summary and the subscription documents. In case you're new to Grocapitus, we manage a portfolio of nearly $1 billion spread across 32 projects with 7 projects sold. Over 900 of you have given us almost $280 million of equity to buy assets like the ones on the screen in blue, or to build new construction assets like this set on the right that's in green, or to diversify your portfolio using assets like these in orange here. No matter the type, our portfolios outperform those that have chosen to not be as patient as we have been and to deliver long-term returns to investors. And there is no better proof of our hard work and our cutting-edge use of data science and our investor-first attitude than this slide. In this white box on the left, you can see the original projections. And then in the blue box on the right, you can see that we doubled both the IRR, that's time value returns, and the AAR, that's simple annual return, on the 7 projects that we've exited so far. And remember, we had to deal with COVID challenges, delinquency, rent control, eviction bans in 6 of these 7 assets. But we made the right decisions, painful as they might have been then, and the results are in front of you. Our investors love what we are doing. Here is Jennifer. She is a super experienced investor, and she compares us to much larger companies with more projects, and she thinks we come out ahead. And she also really enjoys our high efficiency processes and likes the fact that the team has not changed since the beginning. And here is Dr. Pada. He's a general partner with lots of deals on his own. Check out his comments, by the way, in orange. It really comes down to true use of data to optimize results. And we are very, very good at that. And that's why Dr. Pada keeps coming back to us to invest. Okay, let's introduce the team. I'll start off. My friends call me the Mad Scientist of Multifamily because of my focus on data science, process-driven improvement, and also data-driven testing and analysis. Anna has been my partner on this journey since 2018 when Grocapitus began. Say hello, Anna.
Hey, everybody.
And most of you on the call know us well, and dozens of you on the call today have invested in past projects. We are very passionate about real estate investing and its tax benefits. Anna and I spend a lot of time each year traveling throughout the country, and neither one of us thinks that we've come across a location better than the one that we are talking about today in all of these travels. Anna and I lead a very experienced group of dedicated team players led by these 2 experts. On the left, Pete Levine brings both his academic and real life experience to our team. No one's more tied to data-driven decision-making than Pete is, and every project that we have benefits from his amazing sourcing and underwriting and due diligence skills. And when you think of Megan, think of a hawk with sharp claws watching over our projects, counting every dollar. She never hesitates to put a property manager in their place when she's trying to maximize rents or speed up the rehab at our properties. Her team documents their hard work in detailed project updates that all Grocapitus investors love. And Megan and Pete, they've aced the successful completion and lease up of a similar townhome 66-unit built-to-rent community in Idaho Falls. Here are the final pictures of this townhome community, and their teams are taking all of those lessons learned and they're pouring them into phase 1 and phase 2 for the new Braunfels townhomes. In case you're wondering, the Idaho Falls community, the one we just showed you, it's not our only completed townhome project. We've also built more upscale townhomes like this 46-unit community in Raleigh-Durham. Check out the completed pictures. They're lovely. And the team's also finishing up a fourplex build-to-rent townhome style community, now leasing up in Houston. Take a quick look at the amazing quality of this product. So we consider ourselves somewhat of an expert at building townhomes, but we've also completed many apartments and student housing and flex industrial projects successfully, and we're proud to show you the finished product on some of these projects. Every project had obstacles that our team had to overcome, so the experience has made us a savvy team, a nimble team. Okay, now we're going to catch you up on the last 2.5 years of the new Braunfels project. By the way, that picture on the bottom right is a finalized rendering of a 4-townhome building. And we've been refining the exterior look for several years, so we're very sure that this is what the finalized product will look like. Now, EQUINOX New Braunfels was originally developed as a fourplex for sale project, and phase 1 was sold out to buyers over a year ago. However, as you all know, interest rates are going up and loan to value, or LTV, is going down. So our buyers, they became concerned with potentially needing to put more cash in and having lower cash flow. So the buyers felt that we should take a different path, and we agreed. So last year we turned the project around. We turned it into a typical build and hold syndication project that can take advantage of cheaper commercial loans, 4% locked in, and higher commercial appraisals. This is pretty similar to the apartment and townhome construction projects that you just saw. The equity that we used to build phase 1, over $5 million of our money, is being converted with those investors becoming Class A equity. And now that 32 townhomes are going to be ready to deliver in January, we're inviting you to join us for phase 2 so we can complete the entire 122-unit townhome community. And when phase 2 is completed, the community is going to look like the rendering on the right. Phase 1, which is scheduled for completion in January next year, is in the red box. The community is going to have, and you can see it on the screen here, a retention pond near the road. There's going to be a playground with a clubhouse. There's a pool in the back, and then there's this big central grass park. Now, you can't really see it from this angle, but the community is actually stepping up from right to left. So these townhomes on the left, they have a beautiful elevated view of the entire city of New Braunfels. Phase 1 is in an advanced stage of construction. Now, to many of you, dirt and trenches, they don't appear to be advanced, right? But in our world, if we're building townhomes and not apartments, this is actually very advanced. For instance, the Idaho Falls property that we showed you went from dirt and foundations on the left to framing on the right in 3 months. Then it went from framed to exterior complete in another 3 months, and then interior units were delivered another 3 months after that. Stick-built townhome construction is much faster than apartment construction, and that's why we believe we will deliver phase 1 only 10 months from now, with rental income starting in sometime in early 2025. So there's going to be rental income before that, but that's going to be used to pay down our construction loan. All right, so you're caught up on phase 1. You've got a broad understanding of the project. Now we'd like to take a step back and address the state of the real estate market, including the value add multifamily market. We think the economy today, truly bizarre, changes more every week. As of this week, 12 months after the Fed started raising rates, the economy is slowing, the dollar is weakening, and inflation is stickier than we thought. Interest rates for single-family homes are now at 6.5%. So for rentals, they're at 7.5%. But on the other hand, unemployment is still shockingly low at 3.5%, and single-family home prices might have already bottomed out. So absolutely no one anywhere had projected any of this, and we're all just trying to cope with it. 1 year into the crisis, it's now abundantly clear, though, that the housing market's not going to crash. In fact, if anything, the housing market has been shockingly resilient, and the bullish forecasters have been proven right so far. Almost 100% of single-family loans are locked in at rates below 4%. Homeowners have tremendous amounts of home equity, and demographic trends are driving buyers towards single-family homes. 1 year after rates went up, home prices have only declined in the US by 5%. Foreclosure activity, close to zero. Only 3 bubbly markets out of 300 have seen price declines of over 10%. So why is the market so resilient in the face of massively high interest rates? Well, the answer lies on this slide. We're underbuilding severely in this country. The US needs a lot more single-family homes, a lot more apartments. And we know that many of you are worried about inflation. But inflation, folks, is the landlord's friend. It's not our enemy. History clearly shows that when inflation spikes, rents spike. The left side of this chart shows rents from 1974 to 1984 in this green circle. And you can very clearly see that the inflation spike in those 10 years led to a decade of massive rent increases between 6% and 12%. That's 3 to 6 times the historical average of 2% rent growth in a year. And savvy investors know that inflation really can't be killed quickly. It's going to linger for years, which is why we know that we have above trend rent growth in front of us. And this, to us, is the most important slide in today's presentation. On the right, in the green circle, you can see the gap between the monthly mortgage payment and the monthly rent. This gap right here is by far the largest in history. And given that the single family market is so resilient, so strong because they have locked in interest rates, there's just no evidence that this gap is going to decrease anytime soon. And that's our opportunity. That's the reason why we're so bullish on townhomes. People with high incomes cannot afford single family homes, and they don't want to live in an apartment. And the end result of that massive gap is that medium income earners are now priced out of buying a home. This table shows the income change needed to buy a home just over the last 2 years. So in Tampa, Florida, you need to make 123% more to buy a home today compared to 2020. Your salary probably went up 10%. Here in Austin, you need 116% higher salary compared to 2020, and you probably didn't even get to 16%, let alone 16%. And then take a look down here, last line in green, that's the United States. And you need an 88% increase in income compared to 2 years ago to own a home. This is devastating. An entire generation of Americans, over 20 million families, may never be able to buy a home, never. And while this is a great tragedy of this generation, it's also the greatest opportunity for you, for the landlords. So then the big question is, why not just buy existing apartments if the opportunity is so strong? Why build something new? Well, the answer is we'd love to buy rather than build. But we really have no choice, because today when you buy an apartment property, you have two truly awful choices. Your first awful choice is you can buy the property with a fixed rate. Well, then you get trapped in a 6% fixed rate for a minimum of 7 years. Why? Because apartment loans have massive multi-million-dollar penalties for refinancing in the first 5 to 7 years. Also, today's high interest rates mean that you get a low loan to value, or LTV, so you need a massive amount of investment dollars. And that greatly reduces the profit and depreciation for each investor. I mean, it's a terrible choice. And then your second choice is to go with a floating rate and then deal with interest rate risks. With that choice, your interest rate is so high that you get zero cash flow and a huge mortgage. It's an even more terrible choice, which tells us this: the third choice is the right one. It's to build today with locked in 4% construction loans. So by the time the property is built and leased up, rates have had a chance to come down. This is really the alpha business plan, and we're executing it exactly on time on this townhome project. Now, you might find it a little bit frivolous that we're bashing the very thing that's responsible for our amazing track record. But keep in mind, value add multifamily has lost its biggest weapon. None of the results that anyone has achieved in the last 5 years were possible without ultra low interest variable or bridge debt. This is floating debt. Over 90% of syndicators, including us, used ultra low interest floating bridge debt, which really doesn't exist today. And the industry is continuing to make a huge mistake by buying at high interest rates. We feel very strongly that further price reductions are coming in multifamily in the second half of this year, and especially in the first half of next year, when rates and cap rates reset. So best to wait for a year. So what's the alternative today? Well, today, the best alternative is the hottest market in real estate, build to rent or BTR. Starting around 2015, builders around the US started building new single family or townhome product designed from scratch just for rentals. We're not talking about apartments. I mean, tenants have their own front yard, backyard, more windows. There are no tenants above them, no tenants below them. And when COVID happens, this build to rent market, it exploded. Every tenant wants less density, more space. They want more lights and more bedrooms. They want backyards. Build to rent townhome projects are renting in days rather than weeks, and rents are rising fast. With on-site property management, on-site maintenance, BTR is now seen as the hardest and fastest growing segment in all of real estate. BTR tenants stay longer, they pay more, and they default less than any other segment. And new construction means no surprises, no big maintenance bills for at least 10 years. Build to rent attracts higher income tenants that would have been homeowners today, if not for that massive gap that we just showed you between mortgages and monthly rents. The quote on this slide really covers everything that we want to tell you about BTR. So I quote, investing in building BTR communities is a great hedge against inflation, especially if incomes keep growing. This segment is poised for continued growth, as 67% of BTR households are within the 25 to 55 age cohort. These households typically earn high incomes and they are renters by choice. They're also a stickier rental base with average turnover much lower than conventional apartments. And Berkadia also goes on to provide 2023 data from this year that demand for BTR continues to skyrocket despite these economic headwinds. Average rents already over $2,000 a year. Occupancy amazingly high at 96%. This is simply a fantastic market to get into, folks.